This video and channel are brought to you by the XX Network. I am not a financial advisor, nor do I have any background in finance. When I come clean about my brokenness, others catch glimpses of how the real grace of a real God works in the messy life of a real person.
In the early 1980s, Paul Volcker, the Fed chair, slayed the dragon of inflation. And in the period since then, and especially in the period since the global financial crisis, inflation has stayed low, and that has enabled central banks to keep borrowing costs low. That has now changed. In the last 2 years, inflation has rocketed up, and as you can see in this chart, that has pushed global central banks, the Fed, the ECB, and the Bank of England onto an accelerated tightening trajectory.
We have been living beyond our means for over 40 years due to loose monetary policy. Businesses, consumers, markets, and governments have become used to cheap money. We're reversing this 40-year trend by increasing interest rates, which makes borrowing more expensive. The goal is to reduce the amount of fiat currency in circulations and prices will decline. The problem is bad decisions have been made, and those bad decisions are surfacing.
Wall Street lenders led by Citigroup and Bank of America have been forced to wire a $5.45 billion check to private equity giant Apollo Global Management to fund its takeover of auto parts maker Tenneco, cash they came up with themselves after struggling to raise the money through credit markets. The banks have been marketing a $1.4 billion loan and $1 billion secured bond to investors, offering large discounts in a bid to lure potential creditors, but investor orders have come up short. While the banks have not yet shelved the bond and loan offerings, two people briefed on the matter said that the two borrowings were not going well and could end up being pulled. It's on the operating table and the heart isn't beating, but the doctor hasn't called time of death, one lender said.
This is a Financial Times article that I ran through an AI. What this means is that one of the largest investment firms, like Apollo Global, is issuing bonds to finance a large auto parts manufacturer called Tenneco. Tenneco is a Fortune 500 company, 80,000 employees. It's multinational and American-based with $16 billion in revenue. The market would not purchase these bonds. Bank of America and Citigroup had to write a check to cover $5.4 billion. They normally could give this to investors and bond investors and issue corporate bonds, but the market's not buying it, even at a discount. So what does this mean? If you're watching me, you've probably seen Greg Manarino. He says the big one comes when the debt market sells off. He's right. Right now, the debt credit market is freezing. There are no buyers, only sellers.
That shift from a world of cheap money to a world of expensive money is going to have profound impacts on the global economy.
The debt market is interconnected and businesses raise money for expansion and operation through corporate bonds. If there are no investors, what happens to your business? If you took on too much while times were good, you risk bankruptcy. If you want to expand, you can't. Debt is at the heart of the entire system, and what makes matters worse is CPI is over 8%. This means that you have to offer your investors more than 8% for them just to break even. The investors are taking on risk by giving your business money through corporate bonds.
In a world of cheap money, emerging and frontier economies can borrow to pay for crucial imports of food and fuel and service those debts at low cost. In a world of expensive money, they can't. Some, like Sri Lanka, have already defaulted, and it's only action by the International Monetary Fund everywhere from Pakistan to Argentina, which is preventing a larger wave of emerging market defaults and market meltdowns.
If my business owes your business, you have an asset. It's my debt. However, what happens if I go bankrupt? You're then without the money that you lent me. This causes you to go bankrupt as well. And the business you owe is counting on the money that you were going to pay back, and now he goes bankrupt. And the dominoes start falling. The nation of Sri Lanka, Pakistan, and Argentina have all failed in this way. They can't pay back their debts. So they get an emergency loan from the IMF. The IMF is the lender of last resort. So that means it's so bad that Sri Lanka couldn't get a private loan. It was too risky for anyone to give Sri Lanka money, and they were forced to go to the IMF. The IMF charges a high amount of interest because they're the last resort.
The capital raising for the $7.1 billion Tenneco deal, which was agreed in February, has been a thorn in the side of the banks for months now. The fundraising was postponed in July as financial markets sold off, with the surge in interest rates, war in Ukraine and potential economic slowdown weighing heavily on investor interest. It joins a pile of debt from other leveraged buyouts that have been stuck on bank balance sheets that they have been unable to move, generating large losses for the underwriters. So-called hung financings amount to tens of billions of dollars. Banks in September were only able to sell a fraction of the debt tied to Elliott Management and Vista Equity Partners' $16.5 billion leveraged buyout of software maker Citrix, and ended up holding $6.45 billion of the debt themselves. And a group of banks led by Morgan Stanley ended up lending $12.7 billion to Elon Musk to fund his $44 billion takeover of Twitter themselves, debt they plan to hold on their balance sheet for months or longer. The banks financing the Tenneco buyout already knew they had a tough sell but have hoped to sell at least part of the debt package, with plans to hold the remaining $3.05 billion themselves. Apollo, Bank of America and Citigroup declined to comment.
Tens of billions of dollars is not a quote thorn in the side. These are dollars that are owed by bankrupt companies becoming real losses that have to be paid eventually. Bank failures often turn into widespread bank failures, which can then lead to central bank failures. When central banks fail, it creates a big problem for a nation that can cause hyperinflation. First, the markets freeze, and then the central banks will overreact. That's what causes the hyperinflation. Right now, we're witnessing the freeze.
Central banks, both the Fed and foreign, have morphed from the largest buyers of Treasury notes and bonds over the past 2 decades into the largest net sellers. Japan and China biggest monthly Treasury dump on record. Japan and China, both private investors and central banks, sold $118 billion of Treasury notes and bonds in September, their largest combined monthly dump on record, which confirms our suspicions from a September post. This recent development is more concerning, as it seems as if market functioning has become a bigger source of risk, rather than just reflecting the uncertain fundamental environment. For most analysts, the liquidity problems in the Treasury market are not just about rapidly changing prices, they are also a reflection of a dearth of buyers, or an inability or unwillingness of the buyers in the market to mop up all the supply. The fact the Treasury Department has begun discussing the prospect of buying back some of the most illiquid Treasury bonds, says HSBC's Major, is an implicit acknowledgement that faltering demand has begun to cause problems.
The recent market turmoil has caused both China and Japan, the largest holders of U.S. debt, to sell off their treasuries. Treasuries are short-term bonds that the U.S. issues onto the market, which are then bought by banks and governments. This is the debt market. The debt market is currently illiquid, and more sellers than buyers. When you look at a chart, it illustrates buy and sell orders with candles. The bond market is currently in a bear market, meaning there are more sellers than buyers. When bonds sell off, the yield on those bonds increases. There is an inverse relationship between bonds and yields. On the price of borrowing money as bond yields increase, the price of borrowing money becomes more expensive.
In a world of cheap money, Sam Bankman-Fried is a genius, and Mark Zuckerberg is building the metaverse. In a world of expensive money, Sam Bankman-Fried is bankrupt, and Mark Zuckerberg is saying goodbye to thousands of his employees.
The debt was never sustainable. However, the entire global economy is founded upon cheap and easy money. When you reposition the foundation, the dominoes start falling. When the dominoes falls, it creates a situation like 2008. In 2018, the Fed was raising interest rates and suddenly pivoted. Why? Because the credit markets were freezing. Well, this video showed you that it's happening again. CPI is high, and the Fed's job is to fight inflation, but if dominoes are falling, that leads to systemic risk. A scenario like ICE 9 that was coined by Jim Rickards is on the table. This entire system is in danger of freezing. If the Fed stalls, it can spiral out of control quickly. When the Fed starts printing, it will put a bottom in all markets. But if they wait too long, QE and 0% interest rates will have a minimal impact, and they'll have to increase the debt by exponents to make a difference. This is where central bank digital currencies come into play. They can create an environment of negative interest rates and can hand money directly to the people.
ECG, the parent company, Digital Currency Group, one of the largest players in the industry. And now you have another platform for Genesis Capital, saying that their relationship to Gemini and Gemini itself are leading to pausing withdrawals among clients in the industry. Now let's think about what just happened here for the last couple of years. You were earning nothing in a savings account. So you had millions of Americans, also high net worth individuals, also institutions, putting money in these accounts that yielded, say, 8%. And that's conservative. But that's what you got at Gemini for an earn product. And now, with the suspension of withdrawals, they're working to try to bring those withdrawals back. But what happens when the gates are lifted once more? Is this a solvency issue or is it a liquidity issue? And are we going to see more players face more problems? And Genesis, remember, is one of the biggest counterparties in the trading desk in the industry. They put out a statement saying they're still trading, but are the problems more systemic? People are watching very, very closely because there are a lot of people here with money on the line.
The crypto market is in a tailspin, and traditional markets are not far behind. There is no central bank to bail out crypto lenders in the event of a crisis, as there is in traditional markets. Regulatory bodies may have put measures in place to prevent a repeat of 2008 financial crisis, but global markets are still vulnerable to liquidity crises. This video begins with the struggle of a Fortune 500 company to issue bonds. What about other businesses and banks around the world? When these institutions fail, it often leads to a domino effect of bankruptcy.
Be wiped out in this deal. The crypto exchange last raised money at a $32 billion valuation from some of the biggest names in venture capital. You had SoftBank, Sequoia, Thoma Bravo, Tiger Global, among others. I've been on the phone with some of the equity investors in FTX who told me they're expecting their stakes in FTX to be worthless.
Crypto markets are known for being a leading indicator because they're active globally, 24/7, 365 days out of the year. There are also fewer regulations in these markets. In my humble opinion, what we're witnessing is the crypto market is a microcosm of what is happening in the larger macrocosm. Live like there's no tomorrow. Love like you're on borrowed time. Always remember it's good to be alive. Did the AI-generated articles work? I usually look for clips of experts to support the things I say, but this time I used AI to read credible articles instead. If it worked, let me know in the comments below. As always, thank you for liking and subscribing. If you enjoy this content, please consider joining my Patreon.